am Christina Chervinka, the COO and co-founder of 5 Buffalo Capital, and Dustin Chervinka is here with me today. So we are excited he is our CEO and co-founder, and so we are going to go ahead and get started. I know we had scheduled this for earlier in the month, and unfortunately, we had to push it back, but in pushing back the webinar, we were able to see what the Fed was going to do, which we will talk about. So we will go ahead and get going. So in commercial real estate, we know that navigating interest rates and debt is very important. It goes to pretty much everything we do with purchasing or thinking about refinancing or even selling a property. So that's what we want to talk about today. And of course, we're going to start with some disclaimers. So all investments have risk. And I always tell folks you shouldn't invest if you can't bear the risk of losing the principal. So that could be the entire investment, including gains or just the principal. So just make sure that as you're looking and doing research on potential investment opportunities, that those are things that you pay attention to. And of course, this document is not an offer or solicitation to purchase securities. We are here to provide education, our perspectives, research that we've done. So, with anything you want to do your due diligence. And of course, this is not tax, legal, or financial advice. This is just research and thoughts on what is going on in the market. And then, of course, this is related to forward-looking statements. So as you will see with anyone putting anything out there, there are caveats. And of course, no one has a crystal ball and can see into the future that I know of. So we want to make sure that we are doing a lot of due diligence as we make those investments and take care of things like that. So the agenda today is to talk about interest rate trends, capital rates and CRE pricing, the cost of capital, navigating the rising debt cost, markets that we're watching, markets that we are interested in, and then key data points. We do have some questions that came in via email that we want to touch on. And then, of course, just a quick fund update for those interested. So interest rate trends. I love that the Federal Reserve has different offices. And so they each have a unique perspective based on their micro environment, but then they have a macro environment. And so if you go back and you read the documents and the transcripts, which I'm a nerd, so I do, you can see the trends. And so if you're looking at this chart, you can see how federal funds rate, the effective rate has gone up, has gone down. The gray bars are recessions. So you can kind of see how things have happened. You see 2020 where the pandemic hit. And so interest rates went really low until about 2023, 2022, 23, and then they peaked back up. And so right now where we are is that the interest rate has been about 4.25 to 4.5 since September of 2024. And so that the lowest we had seen that before was January of 23. So we are looking at potentially 2 cuts this year. Folks were hopeful that they might start happening in May. But of course, on May 7th, they left the interest rates flat. And so they're kind of in a holding period, watching what's going on in the economy, what's going to happen with tariffs, and really paying attention to the inflation rate. So they want to keep 2% inflation. So looking at inflation, looking at employment, and of course, what's going on. So with the federal funds rate, why does it matter to commercial real estate? Well, I think a lot of us would love to be paying 4.25% interest. But that is basically a rate that the banks look at to determine how much their money is going to cost and then how much they want to charge to loan money out. And so that's why it's important. So Morningstar did a great job at forecasting what they think is going to happen by the end of 2025. So they're forecasting about a 3.5 to a 3.75 rate. So that's going to be another 75 to 100 basis points. And then they're thinking in 2026 about the same. So we could be by mid 2027 starting at a 2.25 to 2.5 rate, which I think a lot of us would be excited to see. So let's move to the trends. So looking at the projections. So when you go to when they have the Federal Open Market Committee meetings and they talk about what the different banks think are going to happen, they are seeing ranges. So this is, you go here and see their monetary policy, but they're saying anywhere in 2025, they could potentially see it, staying around the 4.25 to 4.5, going down to 3.6. 3.6 would be nice. 2026, again, they're seeing anywhere from a more conservative 4.1, meaning that they didn't cut a lot in 25, down to 2.9. And then in 2027, going as low as possibly 2.6. So right there, we're seeing maybe a possible 1 to 2% cut between now and 2027. So just keeping that in mind on the horizon. Of course, they could do the opposite, or they could stay flat. And so that's really why you just want to pay attention to those economic indicators, the inflation rate, the employment, and just kind of what's going on, and track along with the Federal Reserve. And so you see on the chart that they are looking at historical rates, they're looking at what the Fed is implying, and then they're looking at their own forecast. So we just want to make sure that we're tracking with these folks as well. And then what does that mean in real estate? So how do these interest rates then look into or impact capital rates and commercial real estate pricing? So with CBRE, they do great research. And so I did borrow their information because it is good and very well tested. So they are actually forecasting a commercial real estate investment return, an average return of about 9.3 on the annual. And so they're saying in the next 5 years, that's what about they would expect commercial real estate investors to see. And then when they put out their survey in January of 25, about 70% of their investors had plans to buy more commercial real estate assets in 25 than they did in 2024. And then about just under 50% were planning to sell more. And so this competition for assets should allow for pricing to firm up, even with the higher interest rate. So we are seeing prices, people staying pretty firm on pricing. But again, that is very market specific, asset specific, property type specific. So nobody is anticipating prices going down, but more of this stable kind of cap rate environment. And then in 2025, Q1 of 25, we saw a value add going in cap rates at an average of 5.32 and exited about 5.42. So this is where you can see where they're basing that 9.3 annual return average. And then you can also see the going in cap rates. And so when we're looking at doing due diligence on properties, we are, of course, putting a cap rate to it based on what the market is indicating. So that helps indicate what the value is or potential value could be. It's one of 4 ways that you can help value a property. And then looking at the going out cap rate helps understand where that value is going to be in the 5 or 6 years, or depending on where you're holding it. And so looking at those going out cap rates and the cash flow can help determine an exit strategy. And we'll talk a little bit more about that in just a second. So with the slight cap rate compression, as you can kind of see in other webinars we've done, we've been seeing cap rates slightly compress in 2025. And so again, that means that prices are pretty much holding steady, but that NOI is not increasing. So we're thinking there will be more competition in the markets where there's growth, and then historical data has proven investment to be successful. So right now with cap rates compressing, people are saying, okay, we'll still pay more for a lower yield because we have confidence in the specific asset type or the specific market. And so that's really what's holding those prices more stable. And then when you look at Freddie Mac, they did a 2025 outlook, and they think that while property prices declined coming into 2024, they're going to actually moderate in 25, which is very similar to what CBRE is projecting as well. And so with Freddie Mac, they're looking at the starts. So they're looking at the number of properties, multifamily properties that would come online. And so they're saying that there are still high supply. We're still kind of coming out of that supply from folks who bought land maybe in 21 and 22 when we're developing. So we're still coming out of that higher development cycle, but they are seeing less starts. And then with the higher demand, that's really helped with absorption, which we'll talk about here shortly. So how does all of this impact the cost of capital? Well, The Federal Reserve does send out a survey to banks, and they want to understand, and other lending agencies, they want to understand how is the market, and all the different factors impacting how these businesses are loaning out money. And so for all CRE, all commercial real estate loan categories, banks reported that they were tightening their policies. And so what does that mean? So their loan to value ratios, where maybe they used to do up to 80, sometimes 90%, they're backing that down to anywhere from like 55 to 75%. And then those debt service coverage ratios, sometimes you'd seen in the past, maybe they were lower because of the property values being so high and NOI being strong. You might see those debt service coverage ratios be a little bit lower, maybe like 1.15, 1.2, which is pretty low. Now you're seeing anything from like 1.25 to 1.5, 1.55. And so it really depends so much on the particular lender or whichever structure you're going out to, but then also the property and what's going to happen with that property, and of course the cap rate, and the plan for it, whether it's a value add strategy, opportunistic, or if it's core. Those are all going to impact specific loan terms. But overall, banks have had to come back and tighten. And we saw a couple of years ago some banks that had to be bailed out, and they were acting in some cases, not in every case, but generally there is concern when maybe they're over levering their books. They're loaning out a lot of money, and just folks can't pay it back for whatever reason. And usually in a high interest rate environment, it's a lack of cash flow. So going back to how this impacts capital, so if you've got these banks with the tighter restrictions, they're taking on a little more risk, so they're going to charge more interest, and that can make a deal not pencil. So this definitely shows the relation of how the economy is doing. So you can see the market conditions and kind of how they impact the percentage of banks that are forecasting a tightening. So that definitely impacts the cost of capital. And then how is this impacting investors? So you've got the higher interest rates. And so that's really focused investors to go to more agency or government sponsored entities, really behind the traditional banks. So banks are out there lending, but you're seeing people really shopping around and trying to pick up more real estate investment with the institutional investors. So there also was a decline in 2024 of REIT and public pension fund holdings. And that could be for a variety of reasons, but typically it's a rebalance of the portfolio when they make those dispositions and acquisitions. And then, of course, Northmark does a great job with their capital markets. And so they were showing that most commercial multifamily loans, again, are not lending more than 75% loan to value, with most as low as 55%. And then those debt service coverage ratios are anywhere at 1.25, some as high as 1.55. So that cost of capital can really impact the cash flow and whether or not an investment is going to work for a single investor, group of syndicators, or a fund, and even publicly traded REITs. All right. So how do we navigate rising debt costs as investors, as people interested in real estate? What do we do? And unfortunately, a lot of folks who were able to get that higher leverage, so more debt on the property and a lower interest rate, and that lower interest rate environment coming right out of the pandemic, now they're coming up on the end of a 5-year note or a 7-year note, and refinancing may not pencil anymore. So when they're finding those interest rates higher than what they originally purchased at, and now their cap rates have maybe gone higher, or their property values have gone lower, and so they're really concerned about being able to maintain the property and possibly what their exits are. We want to take a breath and turn and look at the REITs. So Dustin and I both grew our careers working for publicly traded REITs, but also private REITs. And they're great in general at really focusing on the fundamentals. And so usually with REITs, you have lower leverage. They are really good at typically lowering their expenses because they have that scale, that economy of scale. And so taking the REIT that's popular or most predominant in your area and really going through their quarterly earnings reports, their annual report, and understanding how they're navigating this type of situation is a really good way to educate yourself and also make sure that you're doing whatever you can to have the best possible outcome with your property if you are an investor in that area. And then, of course, when rents are not moving, sometimes adding some cost-effective amenities, doing that cost-benefit analysis and figuring out if there are amenities that can be brought on for a low cost but high impact, that's a way to potentially increase that NOI and the value of the property. And of course, that might help with the refinance. So there's just different ways that folks need to kind of learn from the REITs, which, as you see in the chart from National Association of the Real Estate Investment Trust, internally, if someone manages the property, they're typically internally managing it. They're gonna have eyes on everything. That's a perfect world. And then with REITs, they're typically very focused on different aspects of just property management, just real estate. And so that's very helpful for them. So that's why I say it's always good to go to the REITs to take a look and see what they're doing, because management matters and experience does matter. And so learning from those experienced public REITs is a great way to help, mitigate some risk and learn different ways to make the best of a situation where maybe refinancing is not the best option. And then sometimes folks in the investment world have not planned out their tax savings. And so they may not be aware where there were missed opportunities and missed tax deductions. So is it possible that working with a CPA could help you understand maybe some savings that were missed? So that might help increase the value or the cash flow. There may be tax changes locally. There might be possible programs that could be implemented to save on taxes. And then, of course, having a tax consultant review that property tax value. I know in some states, property taxes are really expensive and they can be cost prohibitive for doing a deal or possibly increasing the value. And so it's really important to understand how those taxes, whether it's on the income of the property or the actual asset, and of course the land, you just want to make sure you really understand that you've done everything you can while you're in that situation, if you're in that situation. But even just in general, great idea to understand your taxes. So continuing to navigate those rising debt costs. So if we're in a situation where we really need to increase cash flow, increase NOI to be able to successfully exit a property or even purchase a new property, really want to drill down into those non-controllable expenses, like we said, property taxes and the insurance. We can't really control insurance, but sometimes working with the right agent or the right broker, you can figure out ways that you can get savings. It could be enhancing the property in some way, could be upgrading or changing out something. It's really important to understand, to not fear the insurance, but understand what impacts it to be able to have the most efficient way of insuring your property. Don't sell insurance, but I've just talked to so many people in the past and saved money where I could by working with the experts. Controllable expenses, utilities, our lights on sensors, photo sensors, are their low flow plumbing appliances. Is the marketing dialed in? Are we using the right channels, and really focusing on the staff level? And I know it's not popular, but with AI, you can usually get a lot more done than you can with just a person trying to do it all themselves. And so leveraging AI and technology, are you using the right technology to help those team members that you have be more successful? Instead of wasting time doing manual tasks, could they be doing something that is more productive and more cost effective for the team. And then, of course, do you have the right size staff or the right staff? Unfortunately, sometimes people get complacent, and so you just really want to understand those expense drivers. And then with I can't talk. With capital improvements, is the cost benefit analysis still accurate? We are in a tariff environment, and I know I didn't want to say the T word tariff, but we are in a tariff environment. And so if someone is in the middle of a renovation, do they have the supplies at the original cost that they thought? Or are they potentially impacted by tariffs? And how is that going to change the return and the projected income? So just being really cognizant of how the different aspects of the market and what's going on with fiscal and monetary policy can impact you will help navigate those debt costs. So everybody question Dustin and I get asked is, what markets do you watch? Like, what markets do you really like? And so it's looking at what we personally believe, what we have heard from brokers and other investors, and just in general, as we're touring the country and understanding where we would deploy capital. Some things come up, and sometimes I get some head tilts, which would be markets we like. We like Albuquerque. We like in the mountains. We like Albuquerque, New Mexico. Not the only ones. You see the rent change year over year of 3%. There are reasons for that. There are folks moving into the city. There's low supply, different factors that go in to that. And then if you look at South Central, which is kind of your Texas, Oklahoma, you see that Houston is one of the fastest growing cities in the nation. You see the rent growth was minimal, but the supply greatly increased. So that's still a good sign. And that's where you can't always just take one factor. A factor is good, but you need to understand the whole story to know what the trends are coming. So what's coming down the pipeline. Oklahoma City and Tulsa, we've got a lot of industry going in there. You also have a lot of education opportunities, and then you have central location, and then of course you've got low supply, so then that makes the demand higher. Tampa's been built up quite recently. Within the last 5 years there's been a lot of supply, but there's still the demand that's taking that absorption and really making Tampa a great place to call home. And then, of course, in the Midwest, you've had periods where you haven't had a lot of supply, but the demand is increasing as, Omaha is home to the Berkshire Hathaway companies. So lots of insurance companies there. Ohio, similar. And then, of course, Kansas City with all the sports, you've got people, wanting to kind of stay in the middle of the country. And so with low supply and that demand staying stable and increasing in some of those submarkets, you really want to watch and pay attention to those. Markets we are tracking would be Las Vegas. So in the mountain area, we are looking at Las Vegas right below Albuquerque in rent growth, because there is a lot of attention on folks moving to Las Vegas. And even though hospitality is kind of lulled a little bit, you still have folks moving there because it is actually less climate risk there. There's less climate risk, and they do have water there. So they do a lot of conservation, and then a lot of industry and businesses are moving there. We still like to track Dallas, Fort Worth, and San Antonio. While they've had a lot of supply and rent growth has gone down, those are still areas within the Texaplex where you are having industries come in and people are still moving there. So there's still opportunities. Miami is a market that, of course, we're always keeping an eye on because there is low supply there, and it's a great international city. And so we always pay attention there. In the Midwest, we are looking at Milwaukee. We keep our eye on Milwaukee. It's a great universities. It's, near water. It's in the middle of the country and not far from Chicago. And so it's been very popular. And then New York State. So they didn't build a lot in New York State over the last couple of years. I mean, over the last couple of years, New York City has seen growth, but you still have pockets in New York State where there are some opportunities. And so what we do is just pay attention to how the population is growing, what the supply has been, what the absorption is, and of course, we'll cover that in the next slide. But those are just markets that we like to keep a specific eye on. And then we look at where we are in the real estate market cycle as a whole. And then in those MSAs, we're looking at the historic conditions, but also the projections. So in the previous slide, we saw what rent growth has been, but we're also looking at what's coming down the pipeline and those potential opportunities. So when we get folks who are calling us with potential deals and we're doing underwriting, we understand potentially where we have a deal that would work into our portfolio. And then of course, job growth, if people are moving in, if jobs and industry are coming in, then that's great. Everybody needs a place to live. So we definitely want to pay attention to that. The local market conditions, there's a deal everywhere. It's just, is it the right deal for you or for the fund or for the REIT or whatever that vehicle is, whatever that investment structure is. And so we always want to pay attention to the local market conditions and what makes that property different or what makes it the same as the rest of the market and how that's going to impact it. Of course, absorption of new housing supply. So like I said, Houston didn't have a lot of rent growth, but we still like it because so many people are moving to Houston and it is such a big city. So there's definitely room for the right deals to be looked at. And so with all of that, just there are a lot of factors in looking at markets and why we look at them, but definitely pay attention to what the key players in those markets are already doing. And that also will help guide some of those decisions that people are looking to make. Data points to track. So outside of looking at specific markets and submarkets and maybe even specific neighborhoods, we're always keeping an eye on that Fed funds rate to let us know if lower interest rates are going to potentially lower cost of capital. Will that provide more supply? So that could mean that some deals or some markets we like become less feasible for what we're looking to do because of higher supply and potentially lower rents. And then of course, how does that Fed funds rate impact the cap rate and the property values? Regulations. I don't know how often it's very often that I see something super local, hyper local is coming up for rent control or a property tax change. And so you just want to make sure that those markets that you're tracking, that you also set up alerts for local regulation, but state regulation. There was recently a state that regulated rent control, and that could kill some deals. So you just really want to understand what's going on. There are some insurance companies that have pulled out of states, but then the states have come back and said, well, no, we want to talk about that. And maybe we want to legislate that. And so you just really want to pay attention. And of course, the tax law changes. And so how does your investing get impacted by taxes? But then also, how does the tax impact the property? And so how will those two combine? And then tariffs, like I said, the T word, really could impact construction and renovation just depending on where the materials are coming from. Does that make a longer lead time? So is that going to make those units come online later or those homes come online later? And so how is that going to impact the cash flow? And then of course, is that going to cause inflation? So which with high inflation, you tend to have interest rates get change in response. And so you just want to pay attention to those items. And then deal flow. What we like to do is keep information on our markets of interest. So we may not go after every deal, but we'll track on it and see, okay, well, what did that trade at? Okay, so that means cap rates are still, flat, they're staying flat, or they're moving up or down. And just having an awareness of what's going on in the market really helps. Occupancy rates, tracking those rates for the markets of interest, and then looking into trends and what's projected, maybe what the causes are of major swings or just minor swings, rent growth on new and renewals, and then of course those absorption rates. So how are those new units coming online being absorbed in that market? And so is there a high demand or is there too much supply, and how would that impact a potential deal and a potential submarket? So with that, we will go to questions, and I believe we had some put into the email. So Dustin, do you have those questions?
Yeah, can you hear me?
I can, yes.
Yeah, the first question is, how is your deal flow?
So deal flow is interesting, and I always say, and I know this sounds trite, but it ebbs and flows. But right now we are seeing folks who maybe their the life of their fund or their investment structure, their syndication is coming to an end. And so while they don't want to give up the property, maybe they still had some things they would like to do to increase value or income. They can't because of the vehicle that they purchased the property in. So those are some deals that we've seen. Loan maturities, like I said earlier, folks who need to sell or cannot refinance, and the bank is saying, okay, we're done extending. We really need to talk because interest rates are kind of flat right now. We really need to work this out. And so we do have some brokers that'll call and say, hey, look, the bank's going to get this one back. And so are you interested in underwriting the deal? So that's happened. And then some folks get operational fatigue, and there is such a thing as holding on for too long. So when people are underwriting deals, I always recommend really understanding all of the factors that we've talked about and planning multiple exit strategies, because it could be that an earlier exit makes more sense, could be a later exit, but at some point there's that law of diminishing returns where holding on to it just doesn't make sense. And so some folks have realized that it's time to get out of the properties and let someone else take it on with a different strategy.
Great answer. All right, the next question is, what types of properties are you interested in? And I think you've pretty much gave everybody the locations, on your slide presentation, but maybe you can dive in a little bit deeper on the types of properties.
Yeah, so there's like I said, there's a deal out there. It's just how can you get the deal done? So when we look at properties, we have a specific mandate that we have said we're going to do this strategy. So we like a value add strategy. And so when I look at properties, I think about, okay, how would I add value? How would the team add value to this property? And how is that going to increase rents? But the other part of that is how can we lower expenses? Because both impact the NOI. So we're focused on making sure that we do both to impact the NOI. And usually with properties at what we're looking at, we need an economy of scale. So about 150 units to 250 is really what I tend to look for. And then of course, location, um, no deferred maintenance or low deferred maintenance, and then how can we bring value to that property either through renovations to the property, or sometimes it's the pro updating the management, changing out the management team, and then also sometimes it's adding amenities that make sense for that location and for what's going on in the community. I know I worked at a property in Raleigh, North Carolina, and we had an urban vegetable garden, and it was amazing. It was a great amenity. It was low cost. And it was just one of those things where, it brought so much value that you wouldn't have thought it, but it did. So just looking for creative ways to make a deal or a property the best that it can be is really what we look for.
Okay, the next question is from Charlotte. She's got a self-directed retirement account, and she would like to know, how can I invest?
So with a self-directed, I'm going to assume it's a self-directed IRA. We actually did a webinar on this back in February with a custodian. So I would ask Charlotte to go back and watch that, because the custodian is really the expert on kind of the structure and things like that. But a self-directed IRA, I will say, is a way to invest in real estate, but it cannot benefit you personally at that time. So there are rules with it, but yes, it is a way for someone to invest in someone else's deal um, with, with cash that is already kind of set aside. So without, having to go find new investment funds, if that makes sense.
Okay, and the very last question is, are people interested in private real estate and are they investing right now?
Right. So in one of our slides, we showed how REITs are performing and then sometimes outperforming private real estate. And why we watch them is because they're so efficient at property management. And so I will say that there are folks who are looking at doing deals themselves and all of the risk and liability that one could take on their own self. People are looking at partnering and maybe doing syndications, but that comes with a different set of risk. And then people are looking at private funds and what does that mean? And so how is their liability limited? How is their risk increased or mitigated? And so I would just say for folks, right now, what we're seeing in the private space is we've had some folks kind of hesitate because just globally, there were a lot of elections and some turmoil last year. And then now with the tariff situation, it kind of involves the whole world. And so everyone, and it depends on who you are, if you're an insurance company or an institutional investor with a mandate, you will have a different perspective than a high net worth investor or someone who wants to do it themselves, or someone who, is accredited or maybe has a family office. Everyone has a different perspective, but globally, what we saw in 2024 was folks kind of pull back a little bit and hold on to that dry powder. But CBRE is anticipating that investment will go up 33% in Q1, or did go up 33% in Q1 of 2025 to the tune of about $28.8 billion deployed. And so we've heard some folks are kind of waiting, just like the Fed, kind of waiting to see what happens with inflation and the interest rates until maybe the back half of the year. I would just say understand what you personally have going on, what you're comfortable with. Find a financial planner, a tax person, really understand. It's a good time to get educated on what's going on and what you're comfortable with and what plan works for you with a trusted professional. And then understand that there's always going to be people doing deals, there's always going to be people on the sidelines. That's true in the stock market as well. So just make sure that you've done your due diligence and that you're comfortable before you go out and do anything. And that's really what you're seeing with investors just globally in all spaces. It's just some are jumping in and some are waiting to see, and both it's whatever is suitable for that individual. That's
That's all the questions that we have.
okay.
I mean, you did a pretty deep dive, and
I
I'm just kind of thinking that Mr. Jerome should add you as a board member now.
Oh no. Um I love real estate. I would like to stay in real estate.